Welcome to the latest episode of Liquidity Matters. This is Zubair Quazi, your host, CEO, and co-founder of LiquidCapital.AI. And today we have a very distinguished guest, Graeme Muirhead, who is the managing director of Bank of America, also advisor and investor at LiquidCapital.AI. Welcome, Graeme.
Oh, thanks very much, Zubair. I'm delighted to be on the show. So maybe I'll tell you a little bit about my background. I've been in technology in finance for over 30 years. I actually started computer scientist by background. I've been fiddling around with computers since I was before high school. A lot of it was with a soldering iron.
Wow.
Back in those days, I made my first computer in electronics, and then had to go to woodwork to learn how to make to put a case for it. So that's where I started. So you can tell by my lack of hair and the computer that I made that I've been around for a while. I started in finance on the trading floor in London, helping traders make money, basically. And back in those days, a lot of it was pre-regulation. We got involved in every aspect of helping traders make money. Very different nowadays. I'm sure we'll talk about that. I started work. I ended up CIO for Europe for that Japanese investment bank, Daiwa Securities. And 2007, I joined Merrill Lynch, and I've been there ever since. Merrill Lynch, as many of you know, blew up in 2008. Bank of America took them over, and I ended up in Chicago for 4 years, running a technology group. Great time. Myself and my family moved there, and then in 2013 moved to New York, where I again went back and worked in front office technology, risk, Volcker reporting, and so on ever since. So that's my background. I'm very excited to be part of your team and try and help you out, given my experience in the finance industry. Obviously, a technologist, very interested in the technology side of it and how I can help you with that. Some of the many scars that I have of building software that gets used at scale, and help you and the team to try and be successful. So very happy to be on board.
Thank you so much, and welcome aboard. And it is fascinating to know your background and your experience and different places that you worked. And there are a few other interesting things that I know about you, and I've read about. So before we get into technology discussion, but I know you got into Ironman. So if you want to talk about it a little bit, because and how that actually help to evolve in other areas if you're in your career. Right? I know that they're connected in some ways. So
yeah, they are. I mean, it's a bit difficult not for it to be connected, but when I was probably in my 20s in London, I was very sporting at school, and I got out of the habit at college and starting work. I was just focused on building my career. There's a big life lesson here, and so I just worked very hard. I had a lot of fun, in inverted commas, and I ended up with I was very overweight, pretty unhealthy, and had a lot of back trouble. And there's a very long story which you can go read if you want to, how I got out of it. But I met someone that helped me. I started training, started running. I became a big runner, then I became a big cyclist, and then naturally started on triathlon. And I started my journey on triathlon a long time ago, maybe 4 years ago. And that was just a natural progression because I really enjoyed it. And I started doing Ironman. I did my first Ironman actually in 2008. Maybe it was a stress reliever for what was going on in the markets at the time. And I've done since then another 17, so I've done 18 Ironman. I'll do another one hopefully in a couple of months, depending on how my injuries help me out. But yeah, so very keen triathlete. It's helped me a lot. You learn a lot about yourself when you're doing 140 miles, cycling, running, and swimming. You learn how to manage your emotions. remain calm through difficult times. Don't get too excited about when things are going well, and don't get too upset when things are going bad. And then also you learn how to suffer and have a lot of resilience to go through bad times to get to an ultimate goal, right? So that's what I learned out of it. It's been great. Apart from obviously all the time that I've spent, and I wouldn't be able to do it without the support of my family and most especially my wife. So she's been awesome through all of that.
Yeah, absolutely. So this is another fascinating feather. An 18 Iron Man. Oh my goodness, I can't imagine. Well, I'm not that kind of a runner or biker, but I do little things here and there. But kudos to you and hats off.
Yeah,
So
it's a lot. There's a lot of time management that's required, Zubair, to be able to do that for sure.
yeah, I mean, especially you're doing training for it all the time. You have to be on the top of your game, and then of
That,
course you have a very
that's right.
um, demanding job. So technology. So you're in the Wall Street for pretty long time, and you have probably seen, uh, if not three, probably two generation of changes, technology changes in Wall Street. So I just wanted to hear from you, what you have seen and how do you see that technology adoption is going on Wall Street, and what do you see is heading to?
Yeah, I mean, obviously a huge amount of change. I mean, when I started working on Wall Street, we were using Windows 3, and we I mean, it was more about making it work rather than really doing lots of architectural things, and you were really coping with what the technology would give you at the time, rather than now where you've almost depending on how much money you spend, you can almost get unlimited power and capacity, right? So it's a very different approach. I mean, Windows used to crash pretty regularly, so you would have to be constantly on figuring out, even if you want to do the first sort of real-time applications, just making it in any way reliable was an achievement, right? So I think as the years have gone by, I think the biggest change, obviously, there was a lot of focus on trying to make operations more efficient, and really, once technology had exploded, you got beyond it just works. So when derivatives came along, it was, well, let's just do a front to back solution. So you'd have multiple confirmation systems, multiple front office systems, multiple risk systems. It was just a case of getting the businesses up and running. And then you came to the problem with, well, how do we consolidate data? How do we get it so that we can actually report things? And some companies were good at it and some of them weren't, right? It depended how forward thinking they were. But then I think really the biggest change came in 2008 with the financial crisis, and then within banking, the Volcker rules really changed everything in a big way, right? In that and also the required capital and risk reporting that had to be done. So CCAR and Volcker are probably the two really fundamentally changing things that happened. And so you needed to be able to run risk and be able to run scenarios across your entire book, but not not only for market risk but also for credit risk. But then for Volcker, it changed the whole nature, whereby there was no proprietary trading, really significantly reduced, and the types of derivatives that were traded started to become much more centrally cleared, and so it just fundamentally changed the way the trading desks worked. They had to they were much more inspected about what they were doing, why they were doing it, and especially for large banks, it started to be more of a customer business than more proprietary trading. And so the amount of capital, the balance sheet that you could use for your own trading desk trading became significantly less. Not gone away, but it's significantly less. And so I think then the other thing that happened at the same time is the advent of everybody using the internet, and then the application and the iPhone, and so on the sort of commercial and retail side, starting in the retail, banking went online, and so you had a new generation of people where they weren't able to they were expected everything to be online, and so what you had is an industry that was really built on paper and manual processes that had to become automated. And the initial thing was just putting a nice cover on top of it, on top of what you had, and then over time is in just improving that front to back. So the digital explosion that's going on in banking, as I said, especially in the retail and the wealth side, and then on commercial banking, has been a huge driver and continues to be a massive driver. And of course, that has done in the investment banking side as well, because you're now customer focused, with the electronic trading really growing across asset classes, not just equities, but also within fixed income and derivatives. Everything is around how you can support that digital explosion as well as you can. And that obviously creates more data, significantly amounts of data, and you have to become really, really great at combining and reporting on it and aggregating and so on, which creates a whole bunch of new issues. So I've talked quite a lot, but I think those are the kind of the major changes that I've seen.
Absolutely, and I see. I mean, my little experience on deep tech and a little bit on the Wall Street side of it. I mean, I totally relate to it, and my background and our software was getting sold to these financial services companies for a long time. I saw that how much these financial services, big financial services, regulated industry really wanted to adopt the latest technologies. But at the same time, the challenges you just mentioned, that how much you are ready to adopt all those, and then get the complete benefit of the technologies you're actually procuring. That's definitely has come a long way. But the area that I like to touch on is the adoption of these latest technologies are often a little slowed down because of the compliance and regulatory requirements comes in.
Yes, they are. And but that's always in the back of your mind, right? With everything, right? Because it's a risk business, right? And of course, we're not Amazon or Facebook,
Right.
where if something goes wrong, okay, there's reputational risk. But what we're dealing with is people's money. You're not delivering, a package which could get delayed or whatever. Of course, there's implications to that, but it's not the same as the billions of dollars that gets moved around every day. You're dealing with people's livelihoods, people's pensions, and so on. And of course, the regulation is there to protect them.
That is correct.
But then, if you were being a responsible person looking after someone's money, the vast majority of the regulations just make common sense. We might sit here and debate individual ones and how many there are, but that's a separate conversation. But the principles of it are incredibly important. So it's just that speed aspect that you talk about is very much dependent on that. And that doesn't mean, though, that we don't move at speed. And actually speed, I would say the next wave is going to be about how well banks have set themselves up within the constraints that we have from how fast they can go despite that responsibility and the risk appetite that we have, right? That's going to be the differentiator in the future for future financial institutions.
I absolutely, I agree with you. And then the couple of points that I wanted to add to it is the important point. And if you are outside the financial services or the regulated industry, you sometimes feel that why things are moving slow, and why it's taking time. That you actually nail the points that are actually why it is. And in my personal experience, I have also seen that we not only taking care of and protecting people's money, but there's also an importance that we are constantly get attacked by bad actors all the time. So you have to ensure
of course,
that those are all
absolutely. I mean, if you think about that regulatory impact, of course, is very much impacted by the security side, right? And of course, banks are a huge target.
Yep.
And so that automatically, keeps you always concerned about that, what could happen.
And it's a constantly moving, changing industry, and I see that the technology adoption in the financial services are much more, and is going to be more and more as we see, neobank,
Oh
digital
yeah,
banking, and many
the,
other entire now
yeah.
on panel digitization is happening. So it's going to be fantastic to see how things going to go forward. Saying that, so just to track to a different direction. So now we've seen a lot of technology adoption in the public market space, from the financial services to any the trading platform, exchanges, anything you talk about, different generations of things has come in and being technology got adopted. But there's also a bigger market, potentially bigger market on the private market side too. And if you compare, both of them, how do you see the disparity of technology adoption right now?
Well, I think it goes back to the trend that I talked about earlier, which was kicked off as a result of, and it was starting already, but the Volcker rule really was a game changer, because there was no proprietary trading going on within the banks, so that limited their ability to be able to put things on their balance sheet, which then moved people towards private investors, and hedge funds kind of took up that slack. There was still a startup, but then obviously industry. But then I think people have started to say, well, I don't need to go public. That's the other aspect of it. The regulatory side of it around going public is it really worth all the hassle? And can I actually make, a good living and good money out of not going public? And so you've kind of got those two things that affect the banks. There's potentially less companies that are thinking that going public is the right idea and getting going is the right idea, and the lack of flexibility to be able to fund companies, the lack of proprietary. You've got the hedge funds, obviously, which are taking private investors, but tend to be for already existing companies and playing the markets, taking that proprietary positions that the banks are not able. And then for those companies that want to either get going or don't want to go public, well, where do they get capital from? And I think over time, I think there's been a number of, as you know, many successes that have gone. People saying, "Well, look, I want a piece of that pie. I want to have a go at that." And the VCs growing in their importance in getting these companies going, and the level of investment is growing in there because the yields have been very high by comparison for the last X years until very recently, where your yields on normal assets have been very low.
Yeah.
By comparison to what it takes to borrow money. That's yield hungry people are going to go after wherever they can to get extra yield, right? And so I think that's why their private has grown so much, and has grown to an extent that it's a big player now, and we've got to try and find this needle between providing the ability to be able to make use of the capital increase that comes around from private investment, but not bring it into the public domain where it just becomes a security and we end up back where we started. So
Yeah.
this threading the needle is the important thing, and it requires a lot of effort.
I mean, these are very intriguing and great points, and I'm just going to add for our listeners, the size of the private market investment is totally is $14.1 trillion across the globe. Just a significant amount that actually is there. And then there are also the lack of tradability and exits, which are completely dependent on either M&A or, which you just mentioned, IPO. And the IPO numbers has dried out quite a bit. And then we've been seeing some data analysis saying if you had $20 million ARR, you were good to go for an IPO about 10 years back or so. Right now, bar has gone up to 100 or more. But if you look at the number of companies that get invested and number of companies going IPO, the disparity is only, the gap is only increasing. The percentage is shrinking, because $100 million ARR and then sustaining it for a long few more years and then grow from there. Not many companies have successfully done that.
Yeah, it's true enough. Yeah.
Right. So IPO numbers are decreasing, but does it mean that we're going to stop investing in the innovations and supporting this ecosystem? No. So that kind of calls for how we can keep this private market, you know, very dynamic. There's a liquidity events are happening, so the money is flowing and money is not stuck. And at the same time, the benefits are actually, there for the investors and as well as the buyers of these investments.
That's right. That's right.
So,
I think the opportunity that this your company can try and fill, right? And I think various people are sort of filling different parts of it, but I think the idea that you and your team have is pretty unique, and it's a really good opportunity to, as I said, try and thread that needle, because I think it will be very successful when you do, not if.
oh, absolutely. I mean, they're great encouragements, Graham. So yeah, so I'm gonna be direct. So you and I have been talking for quite some time, and then I was, our interaction started in a different way, but then led to a different way right now. But you know, first conversation I had with you, I think it was in July last year or August. I was telling you, this is what I'm thinking, and then I remember the first thing you told me, oh, that's going to be very difficult. And I remember that, and it's going to be very difficult. And you give me a rundown of things, and I was scratching my head. I said, "Yeah, that makes sense." So let me start digging into it and see, what are the things we
Yeah,
can
yeah.
address. I got back to you in November after 2-3 months, and I said, "Hey, we made some progress. This is where we are. What do you think?" And since then, we've been talking. So, how do you see, why we are, and what got you excited to,
Well, I
officially
think it
involved?
was. I think it was the recognition of the fact that it is difficult. I remember reading a book about Elon Musk several years ago, and he was talking about X a long time ago, right? His first real idea, if I remember it correctly, was a bank, and he was going to call it X Bank. And I think he did all the technology work. He did a lot of work. He was ready, doing a lot of things to disrupt the banking business. And I think he really struggled when it came to dealing with the regulations. Going back to what we talked about, and the reasons why, and I think that's led to him abandoning the idea, and that's how he ended up with PayPal, right? And so, hopefully, I've got that right. But that's the story I remember. And of course, having been in the industry for the time I have, and we've started up different systems and different ideas and so on, it's always that's the key. And so, what I thought was important, and what you were talking about, was that you recognize the importance of being able to figure out the details of the financial assets that you want to create and how they'll be traded, making sure that they'll meet the necessary regulatory burden so that people can feel confident that when they trade them, that they're doing so in a compliant way, and in a way that's sustainable in the future, right? I think that's the bit that got me excited about what you're doing, is that recognition. Rather than when I've met a number of other people, it always starts with the technology. But I think that's whilst that's important, it's actually quite a small percentage of the problem, right? I think the skills that you have and your team have got the technology skills to do it. I think it's recognizing the operational and regulatory aspects of it that will really make it successful.
Thank you. So, I mean, you touched on another point that we went back and forth on that. Should we implement first and then look into it?
Yeah.
And again, I think we have a pretty experienced team at Liquid Capital. So we all step back and say, look, technology build-up time will take certain time frame.
Yeah.
But if we go back and forth on the compliance and regulatory aspects, we'll be continuously building something that will not make sense.
Yeah. Yeah.
So
I mean, as you and I have spoken, there are various pieces of the platform that you can build,
right,
are going to be the same, whatever.
right.
But then there's various parts of it that still need to
Correct.
are in the process of being nailing down, and I think that will make that will be hopefully be a differentiator in the future.
Yes, and then just like any other technology implementation, we looked into other solutions if it is there that we can avail and use. We found that there's not many on real-time regulations and compliance checks happens on this side of the industry,
Yeah,
right?
yeah,
And it's probably because my initial point to you that how much technology adoption or application has happened in the private markets. Definitely, there are a lot of things are happening, but as you say, in bits and pieces. But there are some fundamental requirements are there that you can, if you apply the technology there, and they adopt the technology in this space, then the scaling of it would be much faster.
Yes, it will. Yes, it will. Yeah, look, if we talk about something like blockchain within finance, we've been talking about that. I've been talking about that with various people for many, many years. And look, there's no question that the technology is capable of creating, immutable transactions and fractionalizing, the investments that you've made and so on. These are all known now. This is not new information. The problem that everything, a blockchain has to fit into an ecosystem that has a legal underlying legality to it that everybody recognizes as part of the market. And if you get that right, then off you go, right? So I think, as is quite often the case, you start with the business problem, and what you're trying to solve for, and how it's going to work for everybody involved, and then the technology will follow. We've got all the technology we need. We don't have to worry about that.
Yeah, absolutely. It's just how you apply them in the right place at the right time.
Yeah.
So Graeme, it's really fascinating to chat with you. Any last words you wanted to talk about Liquid Capital or anything, any other topic?
I think I'm very excited about where the platform will go and so on. And obviously, with my background, having started on the trading floor, I'm very interested in the actual assets and all the events that are going to take place on them, as you and I have talked about, right? So I find that very interesting as well, because that's the background to the tech that you'll get.
Right.
And so yeah, that's the bit that, if we can get that right, the platform should come fairly quickly. I think there's some really interesting work around the regulatory side, recognition of people getting involved in the marketplace, and how you get that right. That's going to be very interesting in itself, and I think in itself is going to be have very advanced impacts for the future, which I think is also very exciting. So those are the two areas that I think are super interesting, and I'm very happy to have the opportunity to work with you on them.
No, thank you so much. We are actually very honored that you're helping us and getting all the guidance from you. So for our listeners, thank you so much for listening until now. And this is Zubair Quazi. Again, thanking you, Graeme, for joining us.
Yeah, pleasure to be with you.
Likewise, thank you so much. And until next time, liquidity matters from LiquidCapital.AI. Thank you.